Hey investors, welcome back to FiscalVoyage. I'm Felix, and in today's video we're going to talk about the FANG stocks. The FANG stocks are an abbreviation for F for Facebook, A for Amazon, N for Netflix, and G for Google. And I'm also going to be talking about two additional tech stocks later in the end of this video. So make sure to hit the subscribe button if you're new to the channel, and if you'd like to make money, hit that like button. And we're going to determine if there is a tech bubble. You know, basically I'm seeing a lot of articles out there on the internet of tech bubble, where these tech companies just skyrocketed and they're in a bubble territory where they're about to bust and just crash down. So we're going to look at all of these stocks and the two additional stocks at the end of this video and determine if there is a tech bubble. And so let's get started. Again, if you're new to the channel, make sure to hit that subscribe button. Alright, so let's look at the first FANG stock. You can see here Facebook, ticker symbol FB. Facebook stock has been doing outstanding for the past 8 years or so. You can see here earnings been growing tremendously, 66% in 2013, 100% in 2014. Double-digit growth basically throughout the years. In 2019, however, they had a 15% decrease in earnings, but that's not too concerning because the company is expected to grow earnings 46% for 2020. If we put in the price back into the chart, you can see the long-term growth rate for Facebook stock is 34.3%. That's the growth rate for the company throughout the year, basically the average growth rate. But if we show in this time period, the growth rate is slowing down. You can see here 12% for 2021 and then 24% in 2022. But if we look at operating cash flow, I like to look at operating cash flow for growth stocks like a Facebook or Netflix, Microsoft, Google, and things like that. And you can see here the operating cash flow does look attractive for the company. It does look overvalued, however, for Facebook based on the normal multiple. But if you go into the historic, you can see here it does present a decent rate of return based on operating cash flow. And if we go back to adjusted, if we look here, you can see that adjusted operating earnings, you can have a total annual return of 27.1%. So Facebook looks to be undervalued. I actually made a video on Facebook. I had it at around $260. It actually dropped a little bit from that video, and I actually bought shares at around $240. So I took advantage of the dip. But overall, I think Facebook does present a decent buying opportunity right now. You can see here long-term debt to cap is at only 8%, so they have a good balance sheet. So overall, I like Facebook. So let's go to the next one. So we look at Amazon. Amazon is the next FANG, letter A, ticker symbol AMZN. You can see here the price looks very overvalued with a PE of 91 versus the earnings. And earnings is expected to grow about 30% to 40% for the next few years. So that's still very good earnings growth. But the PE, with Peter Lynch, famous investor, he likes to have earnings equal to PE. So basically, if the company is growing at a 30 growth rate, earnings growth rate of 30% or 40%, the PE should equal 30 or 40%. But you see here, right now we have a PE of 91 for Amazon. So, but if we look at adjusted operating cash flow, you can see here it does present, if we shorten this time period, because we're going to look at the growth rate for the past few years and what is expected growth rate, and you can see it does present a decent opportunity here. We put it back to normal PE. It's overvalued based on normal multiple, but still you can still have a nice return at current price. I personally would like for it to go further down, maybe around $2,800 a share, $2,900 a share. I think those will present a good buying opportunity, but it's still long term, still even today, it's a decent opportunity now. Make sure you do your research, but I personally would like a little lower, around $2,900 to $2,800 a share before I were to consider buying it. But it's not overly overvalued as some of the other tech companies that we'll go over shortly. So the next one we're going to look at here in the FANG is Netflix, ticker symbol NFLX. And over here, you can see that the company is overvalued based on the fast graph. Earnings are expected to grow about 45% to 36%. So if we give it a ratio around 40, the PE should be around 40 or maybe even 50. But we have it here, a PE of 82. So it does look overvalued. Even if we shorten this time period, maybe around this time here, you can't get a nice annual growth rate of 19%, but this is with a PE around 58. You can see here this is a PE of 58, which is higher than the growth rate. Again, Peter Lynch likes a growth rate of when a company is growing, like a growth company like this company, have a PE equal growth rate. So if the company is growing 45%, the PE should be 45, or maybe even 50 if you want to pay slightly overpriced for it. But if it was a PE around 30 and growing earnings at 45, buy it. You know, back up the truck and that. But obviously we have a PE of 82 and is growing at 45%. Obviously the previous year has been growing very much faster, but as companies can grow so fast, eventually it starts to slow down, and this is what we're seeing here with Netflix. So there's still potential for return, but the risk is much greater because of the fact that it has a PE of 82. But I could definitely see this stock going higher, but I personally wouldn't be buying shares of this company at this price. So let's go to the next one. So Google is the next FANG stock. You can see here earnings have been growing like a rocket throughout the years. You can see here 41%, 47%, 19%, 28%. So double-digit growth in earnings. 2017 they grew it by 3%. But this year they're expected to grow about 6%, and next year 19% and 16%. So we're showing this time period. You can see here that the company is overvalued based on the earnings. Again, Peter Lynch likes earnings growth to equal PE. So if the company is growing at 19% or 16%, what they're expected, they should have a PE around 20 or 25 or something like that. But over here, Google has a PE of 34. So it looks to be overvalued just based on this. If we look at operating cash flow, let's see here, operating cash flow. Operating cash flow tells a different story. It looks to be undervalued based on operating cash flow with a price to operating cash flow of 21. But you can see here the total annual return is about 6.8%, which is not attractive. But again, if the company continues growing operating cash flow at 24% or more, you could definitely see this price skyrocket. So let's go to another stock, another tech stock, Microsoft, and Apple will be the last one. And we're gonna see if Microsoft is a good price now. Microsoft, in adjusted operating earning looks to be overvalued. You can see here, tremendously overvalued. It's at a 34 PE, and it's only expected to grow earnings about 18%, 10%, 18%. So that's a good indicator that it's overvalued. If we're trying to put in this normal multiple, the market tends to give Microsoft a normal multiple around 21 or 22, and right now you have a PE around 34. So that is extreme overvaluation for this company. You can have a total annual return of negative 2.8%. So that's not attractive at all. I like to see potential rate of return of around 15%, 20%. So right now Microsoft does not look attractive at all. I actually will pass on this company. High quality company. I would love to own this company, but not at this price. I will wait for definitely a big pullback on Microsoft Corp. And the last company let's talk about is Apple. Apple is kind of the same story as Microsoft. To me, I find it overvalued. This is when I actually bought shares, and I'm up almost 100%. But I find this company to be extremely overvalued. You can see here PE multiple of 35. Earnings are expected to be around 21% growth in 2021, 9%, 5%. So you would say around maybe, let's say 15% average earnings growth, right? And if earnings is supposed to equal PE at 15, you can see here is almost double that, a little higher than double. So based on that, I think Apple is overvalued. Based on the fast graph, based on the multiples, what I'm seeing here, earnings yield of 2.79. it's overvalued. Again, this company is high quality company. I own it in my portfolio. I love it. I actually, my main computer is a MacBook Pro. So, I love the company. Just I find it overvalued right now. I'm not buying any shares of this company. Solid credit rating, AA plus, long-term debt to cap ratio of 57%. It's solid because they do have great free cash flow. But overall, I just think Apple is overvalued at current prices. So there you have it. Those are the big tech companies right now. So some are in the bubble categories. I would consider Microsoft, Apple, and maybe a little bit of Netflix as well. But the other ones still look reasonable right now. Facebook looks to be the most undervalued out of the bunch. But I think Apple and Microsoft are definitely not right now. Put them definitely in your watch list. If they were to drop much further, then they present a good buying opportunity, but not at today's price. Amazon looks fairly valued to slightly overvalued. Same thing with Google. But overall, solid. All these companies are solid company, and they should definitely deserve a space in your portfolio. So again, thank you for watching. If you're new to the channel, make sure to hit that subscribe button and like this video if you enjoyed it and made it this far. Thank you for watching. I'll see you guys in the next one.